You spend 30 years building your retirement savings. You maxed out contributions, watched compound interest work its magic, and now you're sitting on a substantial IRA. You feel proud of what you built, but here is what nobody tells you. That IRA you're so proud of could become one of the largest tax challenges your children may face. And the worst part is, most parents have no idea this is even happening. Hi, I'm Mark Wisniewski, President of Southern Incomes. I help pre-retirees and retirees make smarter decisions with their money. I've spent years helping families navigate this exact problem. And what I see over and over again is parents who think they're leaving their children a gift only to discover they're actually leaving them with a big tax bill that could eat up a significant portion of their inheritance. Today, I'm going to show you exactly how this happens, why the rules change, and what you could do right now to protect your family. And what I want to start with is a number that stops most people cold. If you leave your children a $2 million traditional IRA, a meaningful portion of that inheritance could go to the IRS before your children ever get to use it. Not because they did anything wrong, not because you did anything wrong, but because Congress changed the rules in 2019, and most families have no idea what those rules actually mean for them. Let me show you what changed and really why it matters so much. Before 2020, inheriting an IRA was actually a powerful wealth transfer tool. Your children could stretch distributions over their entire lifetime. If your daughter, say, inherited a $1 million IRA at age 50, she could take small required distributions based on her life expectancy, decades of tax-deferred growth, manageable annual tax hits. Families built generational wealth this way. Then, the Secure Act took effect in January of 2020 and eliminated that entirely from most non-spouse beneficiaries. Your children now have 10 years to empty the account completely. Every dollar they pull out gets added to their ordinary income for that year. Here's why that's so damaging. Think about when your children are likely to inherit from you. They are probably in their 40s, 50s, maybe even their early 60s. These are the peak earning years for them. Your daughter might be a physician making $300,000 a year. Your son, well, maybe he's running a business in his highest income decade. They are already at the 32 or 37% federal tax bracket. Now, add a mandatory $100,000 of inherited IRA income on top of that every single year for 10 years straight. Your daughter is already earning $250,000. That extra $100,000 pushes her to $350,000, and depending on her filing status, she could be paying 32 to 37% federal tax on much of that distribution. Add in state taxes in California or New York, and that combined rate climbs even higher. Over 10 years, a significant portion of that inheritance goes to taxes rather than to her. Without planning, a meaningful portion of inheritance may just be lost to taxes rather than benefiting your family. And here's the part that should change how you think about this right now. Many of the most effective planning opportunities occur before account transfers to the beneficiaries. Once the IRA transfers, many of the most effective planning opportunities are just no longer available. The planning window is while you are still here. Now, I want to show you something that really makes this situation even more serious for a large number of families. And it comes down to one question. Had you already started taking RMDs before you passed away? Under the final IRS regs issued in 2024, the answer to that question is going to determine how much flexibility your children actually have. Now, if you die before your required beginning date, meaning before you had started your RMDs, your children are actually going to have some flexibility. They can time distributions around their income, maybe take more in low-income years and take a little less in high-earning years. Now, the account still has to be emptied by year 10, but at least they have a little bit of room to work with. But if you die on or after your required beginning date, meaning RMDs had already begun, that flexibility narrows significantly Under current IRS rules, many non-spouse beneficiaries may be required to take annual distributions during the 10-year period if the original owner died after their required beginning date, while still fully distributing the account by year 10, of course. They cannot wait for a low-income year. They certainly cannot just skip a year. They have to take the money out, whether it makes tax sense or not. Miss a distribution? The IRS penalty is 25% of the amount not withdrawn. Think about what that means for your family where the parent dies at, say, 78. The children are in their peak earning years. They have no choice but to take distributions every year on top of everything else they're already earning. The ability to manage the timing of those distributions really becomes much more limited. And here's the mistake I see constantly. Parents assume their children will just figure it out. They assume the kids will have good advisors. They assume someone will help them time distributions strategically. But think about what actually happens. Your children get a phone call during one of the hardest weeks of their lives. They are grieving. They're overwhelmed by funeral expenses and estate logistics, and suddenly someone is telling them they have complex tax decisions to make, oh, by the way, with deadlines attached. Many beneficiaries do not fully optimize these decisions. They simply follow the default distribution approaches without fully evaluating the tax implications. Research suggests that many beneficiaries withdraw inherited retirement accounts faster than required, often because they don't understand the rules, or they just simply want access to the money. And this just continues to accelerate the tax impact even further. If you're watching this and you're thinking, I had no idea my IRA could create this kind of tax challenge for my kids, you're not alone. This is exactly why I help clients build strategies that protect what they've already built. If you want to see how this applies to your specific situation, I've put a link in the description below to book a time with me. So, what can actually be done about this? Because there is a lot that can be done, and the earlier you start, the more options you're going to have. One of the most effective tools for many families is strategic Roth conversions. Here's the core idea. If you're in a lower tax bracket now than your children will be when they inherit, you can convert portions of your traditional IRA to a Roth over time. Now you pay the tax now at your rate. Your children may inherit assets that can generally be distributed free of federal income tax if applicable Roth requirements have been satisfied. They still have that 10-year rule, but on a Roth, there's no federal income tax on qualified distributions. In some cases, even a smaller Roth balance can ultimately deliver more after-tax value to beneficiaries than a larger traditional IRA. The account balance on paper is not the number that matters. The after-tax number is. But before you can make any of these decisions, you need to know your actual numbers. How much of your retirement savings is in pre-tax accounts versus Roths or taxable accounts? The more heavily weighted towards traditional IRAs and 401ks, the bigger the potential for issues for your heirs. You cannot fix what you have not measured. From there, a good advisor can model what your children's tax bracket actually looks like when you layer in inherited IRA income on top of their existing earnings. Sometimes clients see those projections and their entire perspective shifts. Roth conversions are not the only tool either. Life insurance, charitable giving strategies, trust structures, and asset allocation all play a role depending on your situation. The goal is to leave your children the most after-tax wealth possible, not just the biggest account balance that's on paper. Now, I want to be clear. Roth conversions are not right for everyone. If you're already in a high tax bracket, or if you need every dollar in your traditional IRA for your own retirement, or if your children are in an unusually low tax bracket, the math might not work out in your favor. This is not a one-size-fits-all advice. Everyone's situation is different, and you should work with a qualified tax and financial professional before making these types of decisions. But for many families with substantial IRAs and high-earning adult children, doing nothing often leads to larger tax burdens than are necessary. Here's the bottom line. The IRA you spent decades building could become a significant tax burden for your children, not because you did anything wrong, but because Congress changed the rules in 2019. The 10-year inherited IRA rule means your children may have to pay taxes during their highest earning years on money that you worked your whole life to save. But with planning now, strategic conversions, smart asset allocation, and coordination with your overall estate plan, you may be able to reduce that tax burden substantially. The planning you do today may improve the after-tax value ultimately received by your beneficiaries. The IRA is not just for your retirement, it's your legacy. And legacy planning is not something you want to leave to chance. If you want to sit down and see exactly how this applies to your family, book a time with me. The link is in the description below. Take care of yourself out there, and I'll see you in the next video.